Welcome to the Pro Ticker Deep Dive.
It's great to be here.
Today we are looking at a situation that is, I can only describe it as a total financial paradox.
That's the perfect word for it, a paradox.
I mean, usually when we look at a company, the stock chart and the corporate strategy are at least reading from the same book, right?
Right? They might be on different pages, maybe one is a chapter ahead of the other, but it's the same story.
Exactly. But right now, with Oracle Corporation, it feels like we are staring at two completely different realities. Just fundamentally opposed narratives.
It really is a tale of two markets. You have the equity market, the stock traders, absolutely screaming distress.
Just get me out of here. Everything is burning.
Total panic. And then you have the bond market, the so-called smart money, whispering or honestly shouting, this is the opportunity of a lifetime.
It's a massive disconnect. So let's set the scene for you listening right now. It is February 4, 2026. If you pull up a chart of Oracle, ticker symbol ORCL, it looks like a crime scene.
It is brutal to look at, just a sea of red.
The stock is absolutely cratered. We are talking about a drop from highs above $340 a share down to the 168 to 170 range. That is a wipeout.
It is a massive wipeout. And it's important to put that in real dollar terms, not just percentages.
Yeah.
In terms of market capitalization, we're talking about roughly $463 billion.
$463 billion.
Just evaporated,
Yeah.
gone. To put that in context for you, that is like wiping out the entire value of a major bank like JP Morgan.
Or an oil giant like Exxon. Just
Yeah.
poof, gone.
Exactly. So if you were just a casual observer, maybe you check your portfolio once a week and you just looked at that chart, you would assume this company is on the brink of collapse.
Right. You see a chart like that, you think the business is imploding, you think Enron, you think massive fraud or, a dying business model, a dinosaur getting hit by the meteor.
All of the above, it has all the hallmarks of a company in severe, severe distress.
But here is the plot twist, and this is what we're going to be digging into today. At the exact moment the stock is melting down, Oracle's management comes out and says, we aren't retreating, we're doubling down.
Not just doubling down, they're going all in.
They announced a plan to raise between $45 and $50 billion in new capital this year.
Which is an enormous sum. I mean, you have to stop and think about that number. That is a nation-state level of capital raising.
That's bigger than the GDP of some small countries.
Absolutely. It's a war chest of unprecedented size, especially for a company whose stock is ostensibly in free fall.
Huge. And they are doing it to build out what might be the largest infrastructure backlog in the history of cloud computing. So the mission for this deep dive is to figure out the truth here.
To reconcile these two realities.
Is Oracle a classic value trap that is just drowning in debt and burning through cash? Or is the market completely, fundamentally mispricing the backbone of the entire AI era?
That is the central question. And to answer it, we have to look past the noisy stock price. We have to.
You have to ignore the screaming.
You have to ignore the screaming from the equity traders and get into the plumbing of the deal, the nuances of the technology, and listen to the signals coming from the debt markets.
Yeah.
Because that is where the real story is hiding.
Okay, let's unpack this crash first. Because you don't lose $500 billion in value without a reason, or at least without a narrative. The chart looks ugly. I've seen traders on my screen talking about a death cross.
Oh, yeah.
What exactly is happening there technically? What is a death cross?
Well, technically speaking, a death cross is a momentum indicator that it makes technical analysts wake up in a cold sweat. It's a really bearish signal.
So it's as bad as it sounds.
It's as bad as it sounds. It happens when the 50-day moving average of the stock price, so the average price over the last 50 days, slides below the 200-day moving average, the long-term trend.
Okay, so the short-term momentum is collapsing faster than the long-term momentum.
Precisely. It signals that the trend is not only negative, but it's accelerating to the downside. It's a huge psychological blow to investors because, frankly, it often triggers algorithmic selling.
Ah, the robots.
The robots,
Yep.
the algorithms see that cross and their programming says sell. It can become a self-fulfilling prophecy. And right now, Oracle is trading in that 168 to 170 band, which is a massive psychological battleground. The robots are selling because the math tells them to.
So the robots are selling, but the humans are selling too. It's not just the algorithms driving this down. What is the bear case here? Why is everyone running for the exits?
It really boils down to three main fears, and they're all intertwined. You've got dilution, capex shock, and cash flow.
Okay, let's take them one by one. Dilution. That feels like the most immediate pain for a shareholder.
It's the one that hits your wallet today. So to raise this $50 billion war chest, Oracle isn't just borrowing money, they're issuing new stock.
They're printing shares.
They're printing shares. They have what's called an at-the-market program, an ATM program, to sell up to $20 billion in common stock. Plus, on top of that, they are issuing mandatory convertible preferred securities.
Let's pause on at the market. That basically means they're trickling shares into the open market at whatever the current price is, right?
Yeah.
They're selling into this weakness.
Correct. And that is so painful for existing shareholders. Think about it. If you own a piece of the company, your slice of the pie is getting smaller every time they issue a new share. You're getting diluted.
And because they're selling while the stock is down in the 160s, they have to issue more shares to raise that $20 billion.
So much more than if they had done this when the stock was at 340. The market absolutely hates that. It feels like adding insult to injury. You're already down 50%, and now your ownership is being watered down.
It's a double whammy.
Okay.
So that's dilution. What's the second fear? CapEx shock.
This is the big one. This is the why behind the capital raise. For the fiscal year 2026, Oracle raised its capital expenditure guidance, that's the money they spend on building things, from an already high $35 billion.
Which is a lot of money.
A huge number. They raised it from $35 billion to $50 billion.
$50 billion in 1 year, that is.
Yeah.
That's hard to wrap your head around. What are they even buying for $50 billion?
Data centers. Concrete, steel, networking gear, power substations, and of course, mountains and mountains of GPUs from NVIDIA and others. They are in a full-blown construction boom.
And that leads to the third fear, right?
At
the
that.
cash flow.
The cash flow reality check. This is where the rubber meets the road. The problem is right now they're spending that money much, much faster than they are making it.
So it's all going out the door.
Right. If you look at their free cash flow per share, it's currently negative. It's sitting at around negative $4.67. So technically, they are burning cash to build these AI factories.
That explains the panic. I get it now. From a traditional investor's perspective, you see money flying out the door, you see your stock being diluted, and you see negative cash flow. That's the trifecta of terror.
It is. It's every red flag you're taught to look for in business school.
And we also have to mention the context here, because this didn't happen in a vacuum. The DeepSeek thing from January,
Yeah.
that rattled the whole industry, didn't it?
It was a very weird month. January 2026, we had the Great DeepSeek Panic. For those who missed it, this Chinese AI startup, DeepSeek, came out of nowhere and released a model that was incredibly cheap to train.
And it was good, right? It wasn't junk.
It performed almost as well as the big, expensive American models, but it cost a fraction of the price, and the market freaked out.
What was the narrative? What was the fear?
The narrative immediately became, oh no, if AI gets cheap to train, the whole gold rush is over. The fear is that nobody needs to spend billions on NVIDIA chips or Oracle clouds anymore.
If you can do it on your laptop, the infrastructure boom is over.
That was the panic. It sent shockwaves through NVIDIA, AMD, and of course the cloud providers like Oracle.
But that panic has mostly settled, hasn't it? I feel like the market realized that was a bit of an overreaction.
It has settled. The market took a breath and realized that, cheap open source models are great for hobbyists and academics, but they don't replace the need for massive, secure, enterprise-grade infrastructure.
A big bank isn't going to run its trading algorithms on a cheap model from a Chinese startup.
Never. And governments aren't going to run their defense systems on it, so the need for secure, powerful clouds is still there, but the hangover from that panic is still weighing on the sector. And Oracle, well, Oracle has these very specific financial worries, the debt, the CapEx, the dilution, that are acting as a heavy anchor even as the rest of the sector tries to recover.
Okay, so that is the ugly side. That's reality A, as we're calling it. The stock is crushed, cash flow is negative, shareholders are getting diluted, and the whole sector is jittery. It's a powerful bear case.
A very compelling bear case.
Now, let's pivot to the countermove. The $50 billion war chest. You mentioned they're raising this $45 to $50 billion. Where's this money actually coming from? You said it's a mix.
It's a very carefully engineered mix. They're calling it a balanced capital allocation strategy, which is, corporate speak for we are pulling every single lever we have.
They're opening every spigot.
Every single one. Roughly 50% of it is from equity. That's the painful dilution we just talked about. But the other 50% is from debt. Specifically, they're issuing investment-grade senior unsecured bonds.
Okay, so half stock, half debt. And wait, before we get to the debt part, which I think is the craziest part of this story, I want to touch on something you mentioned about the spending. The $50 billion in CapEx, they aren't just buying every single chip outright, are they? There's a nuance there about renting capacity.
Yes, and this is a crucial point for understanding why the cash burn might not be as catastrophic as it looks on paper. The management team has been very vocal about a rent versus buy strategy.
How did that work?
So instead of buying every single server, every piece of cooling equipment, every rack up front, which is incredibly capital intensive, they are partnering on hardware or leasing capacity where it makes sense.
So they're sharing the cost.
They're sharing the cost and smoothing out the cash outflows. It allows them to scale up faster without having to write a $50 billion check on day one. It's a way to keep the immediate cash burn lower than that headline number might suggest. They're trying to manage the pain.
Okay, that makes sense. It's smart accounting, smart financing. But let's get back to the debt, the other $25 billion. This brings us to what I think is the most fascinating part of this whole deep dive.
I agree.
The bond market's verdict. Usually, when a company with negative cash flow and a falling stock price says, hey, can I borrow $25 billion?
Yeah.
What happens?
The banks laugh and slam the door in your face.
Yeah.
Or if they do lend you money, they charge you credit card interest rates. It's called junk debt for a reason.
So what happened here with Oracle?
The exact polar opposite happened. When Oracle went to the market to raise the debt portion, about $25 billion, they didn't just find buyers.
They found a stampede.
A stampede is the right word. The offering was oversubscribed by 5 times.
5 times. So, wait, do the math for me. Investors offered them how much money?
Over $129 billion in orders came in for a $25 billion offer.
That is a staggering signal. It's completely at odds with the stock price.
Completely. You have to understand, bond investors are the smart money. These are not day traders on Reddit chasing memes.
No.
These are pension funds, insurance companies, sovereign wealth funds. They are incredibly risk-averse. Their number one job is capital preservation. They care about one thing and one thing only, getting their money back, with interest.
And if they thought Oracle was a value trap or a dying company?
They wouldn't touch this paper with a 10-foot pole. The fact that they were fighting over each other to lend Oracle money tells you they see something completely different from what the stock market sees. They couldn't get enough of it.
It's just a huge disconnect. The stock traders are dumping their shares, they're selling the furniture, and they're running out the door screaming fire. Meanwhile, the bond traders are lining up with buckets of cash, fighting each other to lend Oracle money.
Exactly. And it gets even weirder. Look at the credit default swaps, or CDS.
Okay, explain CDS simply.
They're basically insurance policies. An investor can buy a CDS to protect themselves if a company goes bankrupt and defaults on its debt. So if the risk of bankruptcy goes up, the price of that insurance goes up.
Makes sense. So what happened to Oracle's CDS price when they announced this massive new debt plan?
The price of that insurance actually dropped. It fell by 17% to multi-year lows.
So it became cheaper to insure against Oracle going bust, even as they were loading up the balance sheet with billions in more debt. That makes no sense on the surface. How do you explain that?
It makes perfect sense if you view the capital raise not as a sign of distress, but as a de-risking event.
De-risking. How is taking on $50 billion in obligations de-risking?
Because the bond market is looking at this and saying, okay, the biggest risk was that they wouldn't have enough money to build out their infrastructure and fulfill their contracts. Now they have the cash. The risk is gone.
So the money isn't a problem, it's the solution.
It's the solution. They believe the money will be put to work and will generate massive returns. They aren't worried about solvency. They're confident in the growth engine that's being built. They see the debt as rocket fuel, not as a weight.
And the credit agencies, Fitch, Moody's, they must hate this kind of leverage.
You would think so. But they affirmed Oracle's investment grade rating, despite the fact that net debt is projected to head towards $290 billion by 2028, which is a scary, scary number. The agencies are saying, we trust the cash flow engine that is being built.
They're looking at the future.
They're looking at the future cash flows that this infrastructure will generate, not at the current burn rate.
Okay, so the bankers and the bond gurus believe in the engine. Let's talk about the engine itself. Why does Oracle need $50 billion? What are they building that is so expensive and so important?
They are building the physical infrastructure to service a backlog of contracts that has, frankly, exploded in a way I've never seen before. To understand this, we need to talk about one key metric, RPO.
RPO. Let's define that very clearly for everyone.
RPO stands for Remaining Performance Obligations.
Which is basically the signed contracts pile, right? It's money that has been legally promised to them, but it just hasn't been billed yet.
Precisely. It is the best forward-looking indicator we have in the cloud world. This is not, we hope to sell this much next year. This is, we have a legally binding contract to sell this. It's already in the bag.
Okay. So what is Oracle's RPO?
Oracle's RPO has hit $523 billion.
Excuse me. Did you say billion with a B?
$523 billion. $500 billion.
I don't even know what to compare that to. That's a mind-boggling number.
It is. And the growth is accelerating. In the most recent quarter, they added $68 billion in net new RPO. To put that in perspective, that's roughly 5 times higher than the base of new contracts they were adding just a year ago.
So the business is accelerating into a brick wall of demand.
That's a perfect way to put it. They have so much demand, they literally cannot build the data centers fast enough to service it. That's why they need the $50 billion.
I have to play devil's advocate here, though, because I remember a few months ago, there was a lot of worry that this backlog was fake, or at least way too concentrated. Everyone was saying, oh, it's just one big contract with OpenAI, it's all Project Stargate. The fear was, if Sam Altman changes his mind, or if Microsoft snaps the leash on OpenAI, Oracle is left holding a $100 billion empty building.
That was the Project Stargate fear, and it was a valid concern. Concentration risk is real in any business. If your entire future is tied to one customer, you're in a very precarious position.
So what's changed? Has that been de-risked?
The new data de-risks that fear significantly. The backlog is diversifying, and it's diversifying with the biggest names in tech.
Okay, who else is in there? Who is signing these massive checks?
It's a who's who of the AI industry. You have Meta, Facebook signing enormous deals to train their Llama models. You have NVIDIA themselves.
Wait, hold on a second. NVIDIA is using Oracle. Doesn't NVIDIA make the chips? Why would they pay Oracle to use their own hardware? That feels counterintuitive.
It does, but it makes perfect sense when you think about it. They make the chips, yes, but they need a massive high-performance cloud environment to run their own simulations and training for the next generation of chips.
So they're designing the future B200 or X100 on Oracle's cloud.
Exactly. The fact that NVIDIA, the kingmaker of AI, the company that knows this hardware better than anyone on the planet, chooses Oracle's infrastructure, that says everything you need to know about the performance.
It's like a Michelin star chef choosing to eat at your restaurant on their day off.
It's the ultimate validation. And it's not just them. You have TikTok, you have xAI, that's Elon Musk's company, and you have AMD, NVIDIA's biggest rival. They're all flocking to Oracle.
So why? Why are they all choosing Oracle? I mean, Amazon's AWS is bigger. Microsoft Azure has the deep OpenAI relationship. Google is Google. Why are all these hyperscalers going to what was considered a second-tier cloud player? Is it just price?
It's not just price, although they are competitive. It comes down to physics and network architecture.
Right.
And it solves a problem that we call the noisy neighbor problem in cloud computing.
I have had noisy neighbors. It's terrible. I assume it's even worse inside a data center.
Much, much worse. In a traditional cloud, like AWS or Azure, you are often sharing the network bandwidth and other resources with other users, other tenants, on the same physical server or switch.
So my app could be running next to someone else's and I wouldn't even know it.
Right. And if your neighbor suddenly starts a massive data-intensive process, like a huge download or a database backup, your performance might dip. Your app might slow down.
For running a website or a simple database, that's probably fine. You won't notice a few milliseconds of delay.
Exactly. But for training a massive AI model, where thousands of GPUs need to be perfectly synchronized, talking to each other constantly, it's a disaster. That little bit of interference, that latency, it ruins the whole process.
And latency is the absolute enemy of AI training.
It's the killer. If one GPU in a cluster of thousands has to wait for data because of a noisy neighbor, the whole cluster slows down. It's like a convoy of 1,000 trucks on the highway. The entire convoy can only move as fast as the slowest truck.
Okay, so Oracle's architecture handles this differently. This leads us to their secret sauce.
The Gen 2 cloud.
This is where we get a little technical, but let's keep it simple for everyone listening. How does Oracle solve that noisy neighbor issue?
They use a fundamentally different design that they call off-box virtualization.
Okay, let's unpack that. Off-box virtualization, what does that mean?
Think of a typical cloud server as a single computer. The main CPU, the brain of the computer, has to do everything. It runs your application, but it also has to spend some of its energy managing the network traffic, running the security firewall, and handling the virtualization layer that separates you from your neighbors.
So it's juggling a lot of tasks. It's like a chef in a busy restaurant who also has to wait tables, wash dishes, and manage the bookings.
That's a perfect analogy. The chef is distracted. They can't focus 100% of their energy on just cooking the food.
Right.
What Oracle does is they take all of that other work, the dishwashing, the waiting tables, the network management, and they move it off the box. They put it on a completely separate, dedicated card called a Smart NICLI.
Smart NICLI, Smart Network Interface Card.
Correct. So the main CPU and, more importantly, the expensive GPUs are 100% dedicated to the customer's workload. The chef just gets to cook.
So when you rent a server from Oracle, you get 100% of the power you pay for. No distraction, no overhead.
Exactly. And because the network is isolated and managed by this separate brain, the smart NAC, they can enable a technology that is critical for AI. It's called RDMA.
RDMA. That sounds fancy. Remote Direct Memory Access. What is that?
Think of it as telepathy for computers. Normally, if computer A wants to send a piece of data to computer B, it has to go through a long process. The data goes from memory to the CPU, gets processed, goes out the network wire, gets received by the other computer's CPU, gets processed again, and then finally gets put into the memory of computer B.
It's like going through a bunch of toll booths and security checkpoints.
Lots of toll booths. It creates latency. RDMA is like a private superhighway that connects the memory of one computer directly to the memory of another, completely bypassing the CPU toll booth on both ends.
So they can essentially share a brain. The memory is linked.
That's a great way to think about it. It allows thousands of GPUs spread across hundreds of servers to talk to each other as if they were one giant, single supercomputer.
And the performance stats back this up. Is it actually faster in the real world?
They do. Independent tests show that Oracle Cloud Infrastructure, or OCI, achieves about 80% lower network latency than comparable cross-cloud setups.
80% lower.
In the world of AI training, where time is literally money, we're talking millions of dollars in electricity and GPU time, that speed advantage is everything. If you can train your new AI model in 4 weeks instead of 6 weeks, that saves you millions of dollars and gets your product to market faster.
That is a compelling pitch. If I'm Mark Zuckerberg or Elon Musk, you're selling pure speed.
Yeah.
But there is another piece of this puzzle regarding the chips themselves. We talked about that $50 billion spending plan. Is Oracle actually buying all these NVIDIA chips themselves? Because that sounds incredibly risky given how fast they become obsolete.
Not necessarily. And this is a strategic shift that I think is absolutely brilliant on their part. They are moving aggressively toward a bring your own chip model, or BYOC.
Bring your own chip. How does that work?
Historically, the cloud provider, Amazon, Microsoft, Google, they buy the expensive chips from NVIDIA, they put them in the servers, and they rent them out to you by the hour. The cloud provider owns the hardware.
But those chips depreciate so fast.
Yeah.
A brand new GPU is basically obsolete in 3 years, maybe even 2. That's a huge balance sheet risk for the cloud provider.
It's a massive risk. If you buy billions of dollars worth of NVIDIA's H100 chips and then the new, much faster Blackwell chips come out, you're suddenly stuck with a bunch of old, less desirable inventory.
So Oracle is flipping the script.
They're flipping the script. They are building what they call compute shells. They provide the building, they provide the power, the networking, the physical security, and crucially, the advanced liquid cooling, which is essential for these new, incredibly hot chips.
And the customer brings the expensive part.
The customer or a hardware partner buys the GPUs and plugs them into Oracle's shell.
That is so smart. It's like being the landlord of a shopping mall instead of owning one of the stores. You own the prime real estate. They take the risk on whether the fashion they're selling goes out of style.
Precisely. It insulates Oracle from the risk of betting on the wrong chip. If NVIDIA gets displaced by AMD in a few years, or if Meta decides to use its own custom-designed chip, Oracle doesn't care. They just provide the shell. They're selling the picks and shovels, or maybe more accurately, the shed to store the picks and shovels.
And there was one other small but vital detail in the notes about data egress. Why does that matter so much in the AI world?
Data egress fees are the hidden tax of the cloud. It's the cost to move your data out of a cloud provider's data center.
And AWS is famous for this, right?
They are notoriously expensive. It's the Hotel California model of cloud computing. You can check out anytime you like, but you can never leave. At least not without paying a huge fee. They trap your data to keep you locked into their ecosystem.
Right. It creates vendor lock-in.
Oracle is aggressively attacking this vulnerability. They are roughly 13 times cheaper for moving data out compared to AWS. For these massive AI models, which can involve petabytes and petabytes of data, that difference saves millions of dollars.
So it makes Oracle a much friendlier, more neutral place.
It does. It means you can come to Oracle, use their super fast infrastructure to train your model, and then move that trained model to another cloud for deployment without getting hit with a massive bill. They aren't trying to trap you.
That leads perfectly into their new overall strategy. In our notes, you called it the cloud-neutral Switzerland approach.
Yes. For a long, long time, Oracle, under Larry Ellison, tried to kill AWS. They wanted to be the only cloud you ever used. He's a competitive guy who wanted to win it all.
But that war didn't go so well for them.
They realized that war was over. AWS won the general-purpose cloud war years ago. So Oracle pivoted from trying to compete head-on to a much smarter strategy.
Now they're colonizing the other clouds.
That is a great way to put it. They launched these new services called Database at Azure and Database at AWS.
Which means exactly what it sounds like.
It means you can physically run Oracle's heavy-duty, high-performance database hardware inside a Microsoft or Amazon data center.
Wait, really? So they're putting Oracle-branded machines running Oracle software inside Amazon's house? That seems unexpectedly friendly for two bitter rivals.
It's incredibly pragmatic. The cabling connects directly from the Oracle machine to Amazon's network with virtually zero latency. This is huge because almost every big company on the planet, banks, airlines, logistics firms, their most critical systems of record run on an Oracle database.
It's the heart of their business.
But they want the flexibility and all the other services that AWS or Azure offer for their newer applications. Before, they had to choose. It was a technical nightmare trying to connect the two worlds. Now they can have the best of both.
And how is that performing? Is it actually working as a business?
The multi-cloud database business grew 817% in the second quarter.
800%. Okay. That validates the strategy pretty definitively.
It's exploding. It turns out if you give customers what they actually want instead of forcing them into a walled garden, they spend a lot more money with you.
And they also have this universal credits thing to make it even easier.
Right. It used to be a nightmare of different contracts and billing systems. Now a company can buy one single pool of Oracle credits, and they can spend those credits on Oracle services running on Azure, on Google Cloud, or on Oracle's own OCI. It completely removes the friction.
They're making it as easy as possible to give them money. That's always a good business move.
Always.
Let's touch on the boring stuff that I actually think is super important in this story. Sovereign clouds. The European Union.
Boring, but incredibly profitable and sticky. Europe is getting very, very strict about data privacy and data sovereignty. You have new regulations like DORA, the Digital Operational Resilience Act.
And what does that mean in simple terms?
It means that governments, banks, and other critical infrastructure companies in the EU need their data to stay physically located in their country, and in some cases be operated and managed only by EU citizens.
So no Americans allowed in the server room.
Basically, no foreign government, not even an allied one, can have any potential access to the data. Oracle is leaning into this hard. They're building completely partitioned AI factories specifically for this market. They have huge investments going into the Netherlands, Germany, and Spain.
They're building these walled-off, country-specific clouds.
Exactly. The big hyperscalers like AWS and Google have a harder time doing this because their networks are designed to be global and interconnected from the ground up. Oracle's newer architecture is actually easier to slice up and isolate.
So they're winning the high-security, high-regulation government and finance game.
Which is incredibly sticky revenue. Once a government moves its national tax system or its defense ministry data to your sovereign cloud, they are never, ever leaving. It is the ultimate moat.
Okay, we have painted a very, very rosy picture of the technology and the strategy. The bull case is powerful, but we have to go back to the bear case. We can't just ignore the risks. I want to push you on this debt again. The numbers are just daunting. Debt-to-equity ratios are estimated to be over 400%.
We absolutely have to look at it with a critical eye. The numbers are terrifying if you are a traditional value investor. A 400% debt-to-equity ratio is leverage to the hilt. It leaves very little room for error.
So what happens if things go wrong? What's the nightmare scenario?
The gamble, and make no mistake, it is a massive gamble, is that this AI demand is durable and converts to cash flow quickly. If AI demand cools down even a little bit, Or if that $500 billion backlog takes longer to convert to actual billable revenue than they expect.
Oracle is in a world of trouble.
A world of trouble. They are servicing a massive, massive debt pile with negative cash flow. If interest rates were to spike again, or if the global economy turns south, that debt burden could become a noose around their neck.
And there's an actual lawsuit hanging over this, right? The Ohio Carpenters Pension Plan.
Yes, there is a class action lawsuit. The allegation is basically that Oracle misled investors about the need for all this financing. They raised some debt in late 2025, suggesting things were fine, and then just a few months later, they suddenly turned around and said, actually, we need way, way more money.
And that caused bond prices to fluctuate wildly.
Yeah.
Investors don't like being surprised like that.
No, they hate it. It creates uncertainty. And if this lawsuit gains traction, it could damage their credibility and hamper their ability to raise funds in the future if they need to go back to the well. It adds a layer of legal risk on top of the already high financial risk.
And let's not forget the dilution we started this whole conversation with. Even if this all works out perfectly, the stock count is going up significantly.
That's the simple math that every equity holder needs to face. Your personal share of the future earnings is being diluted every day. You are accepting a smaller slice of the pie today in exchange for the promise of a much, much bigger pie tomorrow.
But you have to really believe the pie is going to grow fast enough to offset your shrinking slice.
Exactly. If the pie only grows modestly, you could still end up with less than you started with. That's the risk.
So we have the crash, the cash, the tech, and the risks. Now let's look at what the market is actually doing right now. We talked about the bond guys being incredibly bullish. What about the whales? The big, sophisticated options traders.
This is where it gets really interesting for the speculators out there. We looked at the whale stream data, which tracks large, unusual options trades. And the institutional investors are making some very specific, very large bets.
What are they buying? Puts or calls?
They are buying deep out of the money calls.
Okay, translate that for the listener who doesn't trade options every day.
It means they are making highly leveraged bets that the stock will go up a lot and relatively soon. They aren't buying options that will pay off if the stock goes up a few bucks. They were buying large blocks of call options with strike prices at $170 and even $190 for mid-2026 expirations.
The stock is at 168 right now. So betting on 190 is a really bold move. They need a massive rally just to break even, let alone make a profit.
It's a very aggressive bullish bet. It suggests they expect a rapid rebound, a mean reversion back towards the highs. There's a theory in the options world called Max Pain, which suggests that a stock price often tends to gravitate toward the price point where the most options contracts expire, worthless for the buyers.
And the data suggests that point is where?
The data is suggesting that point is gravitating up towards the 190 level. It implies a powerful magnetic pull to the upside if the sentiment shifts.
So the smart money in the options world is betting on a big bounce.
It seems so. And the volume put-call ratio is currently around 0.48. That's a very bullish reading.
Explain that ratio.
It means for every bearish put option being bought, there are roughly 2 bullish call options being bought. So despite the ugly, terrifying stock chart, the options market is overwhelmingly betting on a recovery.
And what about the Wall Street analysts, the people writing the research reports and setting the price targets?
They are completely split down the middle. It's fascinating. You have the bulls, like the teams at Guggenheim and Jefferies. They are sticking to their guns, maintaining price targets around $400 a share.
400. That's more than a double from here. What's their thesis?
They're calling it a decade stock. They believe this is a multi-year transformation and that the current sell-off is a historic gift, a chance to buy the future of AI infrastructure at a discount.
Okay, so those are the Super Bowls. Who is on the other side?
Then you have the realists, or maybe the bears, like the analysts at RBC. They've acknowledged the risks, the debt, the execution, and they've lowered their targets.
Down to what?
Down into the $200 range.
Oh, wait a second. Even $200 is...
Yeah, 20 to 30% upside from the current price of $168.
Right. That's the crazy part of this whole paradox.
Yeah.
Even the bearish analyst targets imply the stock is significantly undervalued right now.
That's the core of the paradox we've been talking about. The sentiment on the stock feels terrible, the chart looks broken, but almost all the quantitative analysis from the bond market to even the conservative analysts suggests the sell-off has gone way too far.
So let's bring it all home. We have synthesized a lot of information here. We really have these two competing realities in front of us.
We do.
Reality A, Oracle is a company burning cash, diluting its shareholders, and loading up on a mountain of debt in a very volatile market. It's a classic value trap.
And reality B, it's a company with a $500 billion contractual backlog, a demonstrably superior AI infrastructure that the biggest names in tech are lining up to use, and an almost unlimited line of credit from the world's smartest lenders. And it's trading at a massive discount to its peers, a PEG ratio of around 1.0, which is dirt cheap for a high-growth tech company.
It really comes down to a question of time horizon and pain tolerance, doesn't it?
It really does. Are you, as an investor, willing to accept the very real short-term pain, the dilution, the scary headlines, the gut-wrenching volatility, for the potential of very long-term dominance in a new technological era?
If that bond market is right, and if that massive backlog converts to revenue as fast as the company claims, because remember they said it's front-loaded, then we might look back at this $168 price as the moment the market completely mispriced the backbone of the AI economy.
That is the bull case in a nutshell. But the provocative thought to leave you with is this. What if the AI bubble bursts? Not just a slowdown, but a real pop, like the dot-com bust. If that happens, that $50 billion debt wall they're building isn't going away. Oracle has bet the entire farm on this transition. There is absolutely no turning back for them now.
High-stakes poker with Larry Ellison. I guess I wouldn't expect anything less from him.
It is certainly not a boring stock to watch.
It definitely isn't. Check your own risk tolerance, everyone. This is absolutely not investment advice, but man, it is a fascinating story to watch unfold. Thanks for diving in with us.
My pleasure. It was a great discussion.
That's it for the Pro Ticker Deep Dive. We'll see you next time.